Bitcoin maintained a firm floor around the $118,000 support level, demonstrating investor confidence despite modest downside pressure. The Federal Reserve held interest rates steady today, reinforcing market expectations of stable policy near term. Meanwhile, macroeconomic uncertainty surrounding upcoming US-EU tariff deadlines added caution across risk assets. At the same time, the White House released a crypto policy report calling for federal clarity and legislative action. This combination of policy signals provided structural backstops anchoring digital asset prices. Ethereum remains resilient amid broader market consolidation, trading above $3,800 even as volume softened over the past 24 hours. ETF inflows into Ethereum products continued, helping underpin technical strength despite modest retracements from local highs near $3,820. Market internal metrics such as realized volume and network activity suggest steady adoption momentum among institutional and retail participants. XRP also declined roughly 2.5% following earlier strength tied to regulatory optimism. Solana underperformed with a 3.4% slide amid ETF rotation and macro risk. The crypto market capitalization declined nearly 3.8%, but Bitcoin remained above key technical thresholds, supporting cautious investor optimism. Notably, 92 of the top 100 coins are currently in the red for the day, signaling broad-based risk aversion. Trading volume remained robust at approximately $146 billion, demonstrating persistent liquidity in both bull and bear spells. Key levels held firm, reducing panic selling and reflecting deeper capital anchoring. This divergence between total cap decline and price stabilization points to selective market participation. On-chain data revealed a massive Dogecoin whale accumulation, with wallet flows exceeding 130 million tokens in the past 24 hours. Price action in DOGE approached resistance around 22 cents to 23 cents as this accumulation occurred near breakout zones. Institutional and high-net-worth traders likely drove significant deposit flows into Doge trading desks. This strategic positioning underscores renewed interest in legacy meme tokens where liquidity is still meaningful. Technical indicators suggest potential breakouts if momentum continues.
By contrast, Shiba Inu and BONK tokens experienced sharp retracements of about 5 to 12%, reflecting profit-taking and speculative rotation out of low-liquidity altcoins. Market dynamics show these tokens are highly sensitive to broader sentiment and liquidity flows. Retail platforms recorded elevated sales of meme tokens, even as trading volume normalized. Institutional capital appears to be withdrawing from unstructured token classes, while focusing on regulated or high-cap assets. Analysts warn of increased volatility in thinly traded altcoin segments. A landmark move by JPMorgan and Coinbase created a bridge for Chase customers to link bank accounts and credit card points directly to Coinbase wallets. This integration allows Coinbase wallet funding via credit card reward points, marking a significant step toward on-ramp convenience for mainstream users. Such collaboration evidences growing trust between Wall Street banks and crypto infrastructure providers. Analysts believe this will drive retail adoption as well as institutional onboarding through compliance mechanisms. The move reinforces the evolving convergence between traditional finance and digital asset ecosystems. Meanwhile, Robinhood posted strong Q2 results, nearly hitting $1 billion revenue and doubling EPS year over year, driven by crypto traffic and retail engagement. Its platform assets grew almost 100% year over year to nearly $280 billion, with net deposits exceeding $13.8 billion. Despite robust metrics, its share price remained relatively flat in after-hours trading. Analysts suggest Robinhood's transition from trading app to diversified fintech is now underway. Strong fundamentals now serve as a foundation rather than speculative hype. The White House's newly released policy report recommended immediate SEC and CFTC action to enable federal-level crypto trading infrastructure. It promotes the adoption of the Genius Act and Clarity Act and opposes a central bank digital currency in the U.S. That policy framework aimed to advance regulatory clarity and position America as a digital asset leader. Federal endorsement of seized Bitcoin reserves bolstered institutional expectations for structured asset flows. Markets responded with muted optimism as frameworks remained forward-looking.
Bitcoin price action mirrored macro caution. The price dipped to $116,000, then rebounded toward $118,700, with intraday volatility contained within key technical bands. Analysts emphasize that recent rejection of aggressive rate cut language keeps risk appetite moderate. Resilience amid sideways price action reflects accumulation behavior from long-term holders. Derivative markets in Bitcoin indicated higher open interest despite price retracement. This signals that risk is being hedged rather than abandoned. Ethereum's futures and options markets continued to show rising open interest, reflecting institutional hedging activity amid ETF inflows. Analysts report large collateral flows into ETH-based products, which support valuations above $3,800. Combined with growing network activity, Ethereum's structural momentum remains intact. Institutional models now consider ETH as both a yield-bearing instrument and programmable token. This bifurcation between retail speculation and long-term capital is increasingly material for ETH pricing. XRP futures volume surpassed SOL for the first time in recent memory, suggesting shifting interest toward more compliance-aligned tokens. Institutional participants appear favoring XRP due to its clearer regulatory pathways. Analysts interpret this volume tilt as an early sign of rotation within altcoin capital flows. Token selection now tracks regulatory sentiment as much as fundamentals. XRP's liquidity depth is now appealing investors wary of fragmented market risk. Crypto institutions such as Anchorage Digital moved more than 10,000 BTC, around $1.2 billion between wallets, signaling potential repositioning or treasury allocation. This move by long-standing custodians suggests ongoing structural accumulation or internal rebalancing activity. Such large transfers rarely impact price immediately, but support long-form strategic positioning. Analysts reading chain wallet flows note repeated patterns among institutional wallets. These flows contribute to Bitcoin demand stability across volatility cycles.
Gold and bond markets reflected a cautious but steady risk environment. Gold prices softened modestly amid reduced safe haven demand. U.S. bond yields declined slightly as Treasury auctions saw strong demand. Equity futures for major indexes rallied mildly following trade deal optimism. Inflation data continues to base effects firming near expected levels. This cross-asset calm supports digital asset resilience amid broader policy stability. Global equities advanced modestly as trade uncertainties eased. Both U.S. and European futures closed slightly higher. Emerging markets benefited from commodity-linked optimism, notably in energy and industrial sectors. Analysts noted investor rotation out of speculative algos into macro-sensitive equities. Strategic asset allocation models now incorporate moderate crypto exposure as hedge diversifiers. Cross-asset correlation remains low, reflecting the stage of strategic repositioning. Real estate crypto integration continued with upscale listings priced in Bitcoin and Ethereum in high-value markets. Luxury homes in regions such as Beverly Hills and desert estates now support crypto-only transactions. Smart contract management platforms automate billing and escrow for digital payments ecosystem. Analysts view this intersection of digital wealth and legacy real assets as expanding capital velocity. Institutional liquidity is now seeking integration with tangible asset ownership domains. Stablecoin adoption accelerated amid heightened regulatory clarity, as digital dollars became critical liquidity units for treasury and settlement. Institutional usage metrics show usage of licensed stablecoins spiking in cross-border transfers and asset onboarding. The U.S. government's focus on stablecoin enactment under the Genius Act is reinforcing institutional comfort. Analysts highlight programmable cash as a future mainstay in finance infrastructure. Stablecoins now compete directly with deposit and money market equivalents.
Retail derivative activity surged around Bitcoin and Ethereum options, with OTM call buying and straddle strategies prevalent. Margin balances reflect retail engagement tied to speculative rounds. At the same time, institutional portfolios favor hedged and income-based options rather than directional bets. Market structure divergence between retail and institutional flows continues to shape volatility profiles. This segmentation reduces systemic contagion risk while preserving selective upside. NFT and token-based digital collectibles rebounded modestly as liquidity improved amid Ethereum's strength stabilization. CryptoPunk's floor prices rose over $200K again, driven by renewed collector interest and lending market activity. NFT volume remains moderate but more evenly distributed across established collections. Analysts note improved valuation linkage between DeFi yield platforms and NFT ownership models. This signals ecosystem interconnectivity rather than speculative mania. Venture fund activity remains selective, investing in compliance and infrastructure rather than consumer dApps. Capital deployment is now concentrated on custody, settlement engines, and cross-border token platforms. Startups with regulatory alignment and bank partnerships attract attention from institutional funders. Sector confidence is building around enterprise utility rather than speculative token launches. The capital cycle continues favoring structural innovation over short-term yield chase. In summary, today's market narrative reflects measured resilience. In-kind ETF structural shifts, institutional whale flows, new bank exchange partnerships, and digital real estate integration combine to support crypto strength. Macro policy remains steady, inflation data moderate, and trade signal clarity is guiding capital rotation. Institutional and retail segmentation is widening, but opportunity persists within regulated asset channels. Building strategy grounded in liquidity flows, derivative depth, and regulatory visibility positions investors best for the next growth phase.